Good afternoon and welcome to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for your investment strategy and financial goals. We are recording this webinar so those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined on the call by my partner and colleague, Paul Tepsich, the founder of HighRock. And also on the call with us is our financial planner, Bianca Tomlinson. We'll have our question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we certainly invite you to feel free to ask questions. Remember that if you have a question, it is entirely likely that other listeners may have the same question, so please feel free to engage us. Based on some excellent feedback from our listeners in the past, we have changed the format of our weekly call. So if you are a first-time listener and would like a little bit more information on our private client services, we have a separate webinar that will provide you with this on our website adjacent to this weekly webinar. Well, each week we discuss our themes for this year and any new and relevant news that we believe to be pertinent in light of those themes. Our overall and number one theme is to expect the unexpected, and this year so far there have been plenty of surprises, and we certainly expect more to come as we enter the last quarter of the year. But let's start with one that is on the minds of many market participants. At the beginning of this year, many experts expected the Fed to start raising rates sometime in 2015. At first, the focus was on June as the timeline, but weaker than expected first quarter growth pushed that out to September. Specifically, the U.S. Federal Open Market Committee, led by Chairwoman Janet Yellen, referred to the first quarter slowdown as the impact from special transitory factors. In other words, those things that would not likely impede growth in the second half of 2015. In fact, the Fed was rather optimistic about the prospects for growth in the second half, so much so that they continued to suggest that there would be at least one increase by 0.25% in 2015. On Thursday of this week at approximately 2 p.m., the Fed will announce the results of their latest Federal Reserve Open Market Committee meeting. So in advance of that, let's just check in on the latest U.S. economic data for the second half of 2015 thus far. Well, at the beginning of September, we saw that August employment growth came out, but the trend continues to be slowing. But even more importantly, the labor force participation rate remains at levels not seen since the late 1970s and early 1980s. So there is definitely some concerns about whether or not the U.S. is reaching full employment or its levels of full employment. Today we saw data for industrial production. It turned negative in August, according to that report, mainly because of a slowdown in motor vehicle production, among other things. As for the U.S. consumer, who is responsible for 2/3 of the U.S. economy, wages, although they've been a bit erratic, are generally not increasing at any significant pace. Retail sales, although slightly better than expected with a revision to last month, are still trending lower. The key contributors to better numbers, or some better numbers than expected, are automobile purchases and more spending at restaurants. However, the consumer has been borrowing more. Household deleveraging that began following the real estate crisis of 2007 has started to reverse, and this makes the consumer somewhat more vulnerable to any increase in interest rates. But this is not necessarily specific to the United States. In Canada, this has been a very big story. Canadian household debt-to-income levels is at a record. This is okay as long as asset prices are rising and debt-to-total asset levels are falling. However, if asset price growth begins to stall or decline, or if the cost of carrying the debt should grow, or worse, a combination of both, then it does become problematic. Now let's look at this on a global scale. Debt has continued to grow since 2007, but let's take a closer look at this chart. In advanced economies, total borrowing has increased. Interestingly, at the household level, Sweden, Canada, and Switzerland have increased borrowing, while the US, Spain, and the UK have been borrowing less. And now looking at developing economies, especially China, Hong Kong, and Singapore, there is plenty of debt growth since 2007. When interest rates rise, servicing all of this debt is going to become problematic. But it's not just what the Fed does. Credit conditions are already tightening. The spread between a AAA-rated government, or where a AAA-rated government can borrow, which would be T-bills in the short term, and A-rated corporations can borrow, that spread is widening, which means that lenders are demanding more protection to lend. For households, lenders are demanding more security. Now, in Economics 101, this is called the crowding out effect. But importantly, even before the US Fed or the Bank of England raise interest rates, lenders are already making borrowing more expensive. So if the Fed raises rates, then borrowers will be hit harder. Now this, in and of itself, will automatically put the already struggling global economic growth into greater headwinds. So while the Fed is anxious to begin interest rate normalization, or so that's what they've been telling us, because rates have been at their lows for 7 years, the global economic situation may just preclude them from being able to do so. Meanwhile, inflation is running well below the Fed's target, so there really isn't any immediate urgency for them to raise rates. Now, the uncertainty of this and the overall uncertainty of China's impact on global growth has caused volatility to spike recently. And we know that central bankers don't like volatility and uncertainty. So the Bank of England and Governor Carney left rates unchanged last week. And while they outwardly do not see China as a threat to the economy and expect to see inflation growth and a need to hike rates near the turn of the year, recent data puts that forecast into doubt because faltering overseas demand has reduced British industrial output. And the trend of British core inflation remains down. Last week, Canada left rates unchanged, and the European Central Bank's monetary policy also remains accommodative. Okay, so let's check in with the bond markets to see what they are telling us. We pointed out in early August that U.S. high-yield bond markets had turned lower, and that was well ahead of the S&P 500, and that traditionally this was a good leading indicator. Well, now high-yield bonds have stabilized and turned a little higher. While this is not yet conclusive, it does appear that, at least for the moment, equity markets have stabilized. We like the Canadian high-yield asset class in our client portfolios for very much that reason. Less volatility, good diversification, and as a result, excellent risk-adjusted returns. Certainly better than the S&P 500 or the S&P TSX indices that have significantly higher volatility. Well, U.S. bond yields are slightly higher than they were last week, but they are not showing any new changes by the Fed this week. So bond markets are not expecting a September rate increase. Expectations of a better Canadian economy have steepened the yield curve a little more in Canada this week, but there has been very little change to the UK yield curve. And in Germany, not much change to that bond market either. Short-term deflationary fears still show some yields below zero, and longer-term, slightly steepening yield curve shows expectations of slow but improving economic growth. We still think equity markets are expensive, but less so than they were. We are cautious about current values because revenue growth and earnings growth are expected to continue to decline in the third quarter. And as portfolio managers with long-term perspective, we believe that in general markets are cyclical. Now, we're certainly off the recent cyclical highs for equity markets, but it's not exactly clear how far into the cyclical downturn we've moved. So we are watching closely as to how markets are behaving. And it's not necessarily just about the economy, but about the perception of what is to come next. And that's where understanding behavioral finance enters the equation. We want to make sure that we're getting a grasp of what the psychology of markets is telling us. Well, at the risk of being overly repetitive here, it does remain that for the foreseeable future, with low economic growth, low earnings, low commodity prices, low inflation, and low interest rates, we're going to continue to be in a low return environment. And investors will have to continue to adjust their expectations to this reality. Well, as always, we need to stay focused on risk-adjusted returns and not be driven to chase higher returns at the expense of adding risk to our client portfolios. So in our fixed income model, we continue to have three key concerns with our bond investments. The first is interest rate risk. That's the future direction of interest rates and how they affect fixed income assets. Then there is duration risk, where we need to assess which part of the yield curve would be most impacted and where we should be focusing on buying bonds for our clients. In Canada, we have early signs of economic strength, which means that the Bank of Canada is likely not anxious to cut rates further. Canadian core inflation is running a little over 2%, and that leaves us reluctant to buy bonds that currently yield less. And that ultimately gives us negative after inflation returns. Now, we bought bonds at better levels in May, so at this time we have little desire to add to that position. Finally, we also have to be vigilant on the quality of the bonds that we own. This is also known as credit risk. We have to ensure that the companies whose bonds we own are going to be able to make their interest payments and repay the principal. This, of course, is crucial, and we spend lots of time these days on this. Now, with widening corporate bond spreads over higher grade government bonds, we're looking for opportunities that appear currently to be developing. In our global equity model, volatility remains elevated, so we continue to watch closely to see if and when there might be buying opportunities. And this is the application of our disciplined approach. Now, we can still afford to be patient. Historically, higher levels of volatility point toward a potential change in trend, so we are continuing our assessment of markets and what opportunities will prevail. Remember, we invest in companies, not in countries. We purchase exchange-traded funds that own companies that are domiciled in certain countries. But most of these companies are international in scale, as they are quite large companies. So U.S. companies, which comprise approximately 18% of our client 60% equity, 40% fixed income portfolio, well, and the S&P this year is down close to 5.5% on the year. Canadian companies in our global model are approximately 9% of the 60-40 mix. So far this year, the TSX is down approximately 8.5%. Euro area companies represent about 4% of our 60-40 portfolio. This year so far, the Euro Stoxx 50 is up approximately 1%. Japanese companies are about 3% of the 60-40 portfolio. The Nikkei 225 is up by about 3% so far this year. UK companies are about 2.5% of our 60-40 portfolio. Year to date, the FTSE 100 is down about 7%. And Australian companies represent just a little less than 1% of our 60-40 portfolio. Year to date, the Australian All Ordinaries Index is down about 5%. As for China and other emerging market companies, which represent about 3% of the 60-40 portfolio, China's Shanghai Composite is down about 3.7% on the year, and the emerging markets ETF that we buy for our model is basically unchanged on the year. Our 60/40 portfolio, which is comprised of each of our three models, is up near 3.5% so far in 2015. As far as the Canadian growth equity model, let's see if Paul's got anything to add to the conversation.
Scott, thanks. Nothing new in the Canadian growth equity model. We are getting close to a couple of our buy targets on 2 different stocks. And I would add as well back into the fixed income model that we are looking at buying a couple or 3 or 4 investment grade corporate bonds for some of our clients. And I think, Scott, you may want to expand, but as we do so, the existing clients, some clients are in cash, newer clients, and they will just be buying some of those directly. Older existing clients own a couple different ETFs for Canadian investment grade or high yield bonds. As we buy direct bonds, we will sell those ETFs, and our clients will save significant fees in the embedded management fees that we have to pay these other managers like IIROC. Now we do it ourselves, and that's where we save our clients money.
Well, Paul, I think you expanded on that nicely, so I don't have to. So that's it for today's discussion. And if there's anybody out there who might have a question, then this is the time to unmute yourself and join the conversation.
Okay, Scott, so the little chart that you had, or graph, of the fear, hope, and greed, you know, the bottom of the wave was opportunity. Like, what events do you think are going to precipitate opportunity, and how are you going to know, you know, when to get back involved in equities?
Well, let me sort of start with the back end of that question, Kathy, because one of the things that we are when we are mostly fully invested, and for our longer term clients who are fairly fully invested, that means that we may be tinkering with some of the weightings, but we're never going to be fully in cash. Now, it's different for clients who have recently joined us because we've been waiting to build their portfolios and get them started in the investing process. So there's a couple of different things at work. However, going back to the question of where we are in the cycle, we're never 100% certain where we are in the cycle. We may have seen the bottom of the cycle, but our sense is that this also could very well just be the beginning of a longer term situation pointing toward a greater correction. Now, what will tell us whether that's happening? Well, it's going to be the market psychology. We'll get a sense of that psychology. We'll look at how prices are acting. Are we seeing greater volume when there's bigger days of selling and lighter volume on buying days? That is fairly significant, because if there is more selling and that greater degree of selling continues in the market, then it's certainly something that we're going to take into consideration. When that selling starts to dry up, that is going to start to tell us that perhaps we're getting closer to that bottom, and where that opportunity lies is when selling starts to dry up, then and prices remain lower, then that tells us there's a bit of a signal that perhaps we've run out of the selling, and we may in fact have values as best as we're going to get them, and that would encourage us. Sorry.
No, you go ahead.
That would encourage us to start to come into the market. Now, we'll never do anything wholesale. So, and Paul and I sit down and discuss this on an ongoing basis. But basically, when we start to build a portfolio, we are not buying fully into anything. So we'll usually buy a half weight of what it is that we intend to buy at a certain point in time, and then we'll sort of monitor how that market continues to trade, and then we'll determine whether or not we need to add to that position. And it's never 100% certain, of course, that a market's bottoming or topping, but it is looking at some of these indicators that give us these ideas of when we might start to put our toes in the water, as it were.
So when you get a day like today, and I was out, so I walked in and I saw that the market was way up. I don't know anything about the volume or anything, but I mean, is that just, it just happened?
Can I take a crack at that as well,
yes.
Scott?
Yeah, I'll help you.
And I'll answer that second question right now. Okay. Kathy, it's very, very thin volumes. I can tell you it's extremely quiet.
Okay.
Not getting a lot of messages from dealers on the street right now. And the reason being is it's high Jewish holidays. Mm-hmm. And Wall Street becomes very, very quiet and thin, number one. And number two, we've got the Federal Reserve Board meeting in the U.S. to decide the fate of potentially raising short-term interest rates on Thursday at 2 p.m. So there are two events going on that create very thin volumes. And we did have thin liquidity as well through the summer. But going back to your original question, how do we know whether to buy something? Where are we on that fear, hope, and greed line? Right. And for all of our listeners, I mean, Scott and I come from a long history of institutional bond trading for the most part, and that's kind of how we grew up. And what we look at, and we still do today, and we meet regularly and discuss markets all the time at any hour of the day. But we look at three things, and we look at them very in-depthly. And number one, we look at fundamentals. So a lot of the charts that you're seeing on this slide deck presentation have a lot of complex macroeconomic theory behind them that we have views on, and we don't go into that depth when we discuss them here, but we've got fundamental views on the state of the world, the global financial markets, and technicals, so charts that you're looking at. We do look at charts as well, and we pick levels, certain levels that we've noticed behave that way over long periods of time. And the third thing we look at is flow. And that would be, like today, looking at and saying the Dow's up 229 points today, but we know it's on low, thin volume.
Okay.
So we look at all three of those things, and we come up with buy and sell targets on securities that we buy, whether it's an ETF, like on the S&P, or whether it's sometimes we can do it with individual or government bonds. It's harder to do with corporate bonds. We have to do credit work, but that's what we do. We look at everything, and we look at flow, technical charts, and fundamentals. We also look at, as I said, macro events going on in the world and individual micro events of individual companies. And we do all that research, whether it's big picture macro or individual micro. Does that answer your question a bit more? Like, how do we come up with a level to buy the SPY or whatever it might be? That's what we have, and happy to share some of that with you.
Yeah, that's great. Thanks.
Thanks, Kathy. That's excellent questions. We appreciate that. Is there anybody else that's listening to the call that might have a question? All right. Well, if you do have questions and you're listening to this on the recorded version, please feel free to send us an email, pick up the phone, give us a call. We're more than happy to keep those lines of communication open. We're also very, we think feedback is wonderful. It certainly gives us some direction for these calls. So please, if you have the time, please, we'd very much like to hear from you. But that's it for another week, and thank you for taking the time to tune in. Hope you have a great rest of the week, terrific weekend, and we'll look forward to being here next Tuesday. So this is Scott Tomlinson, and I'm signing off.